You guys are consistently losing money with prop firms simply because you do not know how they make money. The majority of prop firms remain profitable simply because of your ego. The prop firms implement rules because they know exactly how regular traders operate. Regular traders look at social media, see what other people are doing, and then try to copy them. That often means switching your strategy all the time because a new one comes out on social media. It also means going for ridiculously high returns and typically also includes a very, very high risk to reward system. That is exactly why the majority of you guys are not able to capitalize off of the prop firm opportunity. So in this video, I'm going to share with you the exact blueprint that I use to make money from prop firms. So the first thing that we're going to be talking about is our risk management approach, because believe it or not, that is what's going to make or break whether you make money through these prop firms. So as you can see, I said a 1-to-1 risk to reward if the prop firm that you are with uses a trailing drawdown or a unrealized trailing drawdown. That is typically futures firms like Top Step, My Fund of Futures, and Apex. The other option is a 1-to-2 risk to reward with no trailing drawdown, and again, that's usually CFD firms like FTMO and Alpha Capital Group. Now, the reason why we want to aim for a 1-to-1 risk to reward is because we want as high of a win rate as possible. The easiest way to avoid trailing drawdowns and unrealized trailing drawdowns is simply by winning more. Now, it's very obvious that the lower risk to reward that you use, the higher win rate you are going to have. Now, while a 1-to-5 or a 1-to-10 risk to reward system may work very well with a personal account, it simply does not work very well with prop firms. Again, the reason for that is because prop firms do not allow for drawdown periods. When you are running a high risk to reward system, drawdown periods are inevitable. So again, we're trying to win as much as possible to avoid the small drawdown that we have, and especially if it's trailing. Now, as you can see, even with CFD firms or forex prop firms, I still recommend a 1-to-2 risk to reward. That is again the absolute highest I recommend. Now, there's no problem in trading a 1-to-1 risk to reward system even with a CFD firm. Now, right here I put consistent risk approach, because the problem that a lot of people have is that they will up their risk when the market conditions are good and they will lower it when they are bad. Now, the thing about trading is it's a probabilities game. So when you decide to up your risk because you personally believe that the market conditions are in your favor that day, that does not mean that you are guaranteed to win. So on the days where you would up your risk, you could technically, no matter how good the market conditions are, lose all of your trades. And on a bad day with bad market conditions, you could still win all your positions. So what ends up happening is that the losers often become way bigger than the winners. That is exactly what we're trying to avoid by using the same risk no matter the setup or no matter the day. This is a very important step, and I noticed a significant difference in my P&L or overall performance once I started to use a consistent risk when we're talking about prop firms. Now, another important topic I want to talk about is when you should avoid trading. As the majority of you guys should know, there are days that are not favorable for you to trade. So those are FOMC mornings, bank holidays, and the day after a bank holiday, the day before NFP, and Mondays. Now, the reason why I do not like trading on any of these days is again because of lack of volume. Now, not trading Mondays is going to be optional. I know a lot of people who do very well on Mondays. It's just been a rule of mine for a very long time. I generally try to avoid Mondays. The rest of these are pretty self-explanatory. FOMC mornings are going to be choppy, are going to have a lack of volume, again because we have a large economic data drop later in the day. So a lot of the big players and institutions are waiting to trade until the FOMC actually drops. So that means the morning of FOMC is likely going to be very, very slow and very, very choppy. The same goes for NFP. NFP is a large market mover, and so the day before NFP is likely going to be choppy because the big players and institutions are waiting to trade until NFP hits. So again, as a trader, you really want to have the probabilities on your side as much as possible. And so by avoiding these very obvious days, you generally have a higher chance of succeeding. Now, I also want to cover the trading system or model that I use to get consistent payouts. This strategy can also be utilized with a higher RR system, but it's simply the best system that I've ever traded when it comes to low RR systems. And the reason for that is simply because I don't need a daily bias. I don't need the higher time frame confirmations for this model to play out. So what we're looking for with this specific model is some sort of inefficiency or a fair value gap. Now, I like to find the fair value gaps on a 15-minute time frame. Now, we're not just looking for any old fair value gap. We are looking for fair value gaps with swing lows placed inside of them. So as you can see, I have marked out a 15-minute fair value gap here. Now, this right here is a swing low created within that imbalance. Now, the reason why this is significant is because this swing low failed to fill the 15-minute imbalance. So we are going to anticipate that when a new low gets put in here, it's simply to fill out more of the inefficiency which the first low failed to do. So again, it's very important that it's a swing low because we also want to have stop losses placed under this, aka liquidity. Now, if you don't know how to classify or spot a swing low or a swing high, it's simply when that is the lowest point of the 3 candlestick pattern. So this candle here is higher than this low, and this candle's low is higher than this low. So it's a solo candle, and that's what we call a swing low as well as a swing high. So what I'll do now is I'll jump to a 2-minute, 1-minute, 3-minute, 4-minute, or 5-minute time frame, and then I will buy that low. Again, it does not really matter what the bias is. It does not really matter where you think price is going to go, because we should see a reaction, and 99% of the time, a setup like this will offer at least a 1-to-1 risk to reward ratio. So a rule of thumb that I have for these trades is if the low that I am turtle souping, as we call it, has not hit conscious min encroachment, which means the middle point of the fair value gap, all I have to do is include that middle point or the conscious min encroachment in my stop loss. So I don't need to include the entire gap if the low that I'm turtle souping has not hit conscious min encroachment. And as you can see, this is the low that we are buying, and that low has not hit or filled the conscious min encroachment of the 15-minute imbalance. So I'll include the conscious min encroachment in that, and I'll target a 1-to-1 risk to reward ratio. And now all there's left to do is simply play out the trade and see what happens. And as you can see, it took price a while to come back down to this low, but we almost hit our take profit in an instant. Now, what you can do, but only if you are trading with a firm that does not have unrealized trailing drawdown, is take 90% of your position off at a 1-to-1, move your stop loss to break even, and then let the rest run to external range liquidity, which could be this high up here. Again, we're doing this to get a little bit of extra profit, but we have already made the majority of our profit, again, because we would take 90% of our position off at a 1-to-1. So let's see what happens here. If I went break even and let the rest run, we would have been stopped out break even, as you can see, but sometimes you can squeeze in a little extra profit. But again, it's very important that you do not do this if the prop firm that you are trading with uses unrealized drawdown. So let's take a look at this Euro USD chart. The example I showed you before was a Bitcoin chart. The example I'm showing you now is a forex chart, and the last example is going to be a futures chart of the Nasdaq. I'm doing this to show you that yes, this does work in most markets. And again, we're looking for the exact same thing here. We have a 15-minute imbalance marked out here. We have a low being put in near equilibrium or constant encroachment, or the middle point of this imbalance right here. And now all there's left to do is to wait for price to reach that low and then instantly buy that low. Now people will ask me, well, do you not wait for any confirmation? Absolutely not, okay? Now, because that low that we are planning on buying is really, really close to equilibrium of the imbalance here, I am going to include the entire imbalance. When the low that is put in the imbalance has not hit or reached equilibrium, well, then all I have to do is include equilibrium in my stop loss. But if the low is close or at equilibrium, I have to include the entire imbalance in my stop loss. So that's exactly what I'm going to do. I'm going to place my entry at equilibrium, a little bit below the low that I want to buy. I'm going to include the entire gap in my stop loss, and we're going to aim for a 1-to-1 risk to reward, just like that, and then we'll play it out and see what happens. All right, that was very, very fast, but as you can see, we would have hit take profit in an instant. And again, you could have done the same thing here, taken 90% of the position off here, and then you could have let the rest run to either this high or the external high somewhere up here. That's completely up to you. But again, very, very simple, same exact setup that we're looking for. 15-minute imbalance, a swing low put inside of that 15-minute imbalance that did not fill the imbalance. It's very important that you do not try to do this on imbalances that has been filled. This setup has absolutely no reason to play out if the imbalance has already been filled. But if you find a swing low within an imbalance, you do not need a daily bias. You do not need a lot. All you have to do is follow the stop loss rules that I gave you and target a 1-to-1 risk to reward. Now, right here is the last example. This is the E-mini Nasdaq 100. That is a futures contract. So a 15-minute chart, we have found our imbalance. We have put in a swing low within that imbalance, and obviously we had had not filled that imbalance yet. So again, I'm going to jump to a 2-minute time frame or a 1-minute time frame, just a lower time frame, and then I am going to buy that low. Now again, the low that we're buying is very close to equilibrium of the imbalance, and at that point I would just include the entire imbalance in my stop loss. So what I like to do is place my entry a little bit below the low, because again, I'm taking this trade because I want this to be a liquidity sweep. And if this is a liquidity sweep, well, then we are going to tap a little bit below the low. So that gives me a better entry sometimes and a little bit more money. This is exactly what I would do. Again, I'm including the entire imbalance in my stop because the low that I'm buying is very close to equilibrium of the imbalance. So let's play it out and see what happens. And as you can see, it went perfectly. So this is the entire blueprint that I use on a daily basis to consistently receive payouts from prop firms. I understand exactly how these prop firms make money, and I try my best to avoid trading like the majority of other people. Because why would I trade like the majority of other people when the majority of other people are not making money? So even though this is not going to look great on social media, again, we're only aiming for a 1-to-1 risk to reward. This is the easiest way to abuse prop firms and actually receive payouts on a consistent basis. So I really hope you enjoyed this video. I can't believe I'm actually giving this information out for free. But again, this was the blueprint on how to actually receive consistent payouts from prop firms. Thank you a lot for watching, and I'll see you in my next video.